The 6 top stocks to buy in June 2021. High growth. Not all stocks are made equal, and the market has been on a roller coaster since the new year, with a big influx of ordinary investors. Many people expect the recent increase in investment activity to continue, given the market's unprecedented gains. If you're interested in buying the best rising stocks this month, then stay tuned till the end of the video, and don't forget to share this video with your friends.
Is that it? Is that the yellow sign, right? Yes, it is. Finally.
Number 6. Dollar General. Dollar General has grown into a significant retail force owing to the fact that the company's more than 17,000 U.S. shops were able to remain open during the shutdown since it offers vital items like food, toiletries, and cleaning supplies. Although nearly 3/4 of Americans reside within 5 miles of a Dollar General, the company's stores are concentrated in towns with populations of less than 20,000 people. The business has carved out a unique niche for itself. It doesn't have to compete with Walmart because of its dominance in low-population rural areas. Unfortunately, the stock hasn't fared as well in the first quarter of 2021. DG is down roughly 1.7% year to far. According to some analysts, sales may drop sharply through 2021, thereby reducing earnings. This worry isn't just exaggerated. It may also present a compelling opportunity. Although Dollar General stock has taken a hit this year, revenue and profitability are still increasing. The company's price-to-earnings P/E ratio is at around. Analysts have been mistaken about the company's performance in the past. Number 5. The Walt Disney Company. Another well-known company on the list is the Walt Disney Company. You probably grew up watching a Mickey Mouse or another Disney figure bounce about on your television screen, even if you've never been to Disney World or Disneyland. Only 35% of the Walt Disney Company's theme parks and tourist attractions are full. When capacity limits are lifted, demand is expected to surge, resulting in a major comeback in the coming months. The company's business has been impacted by the COVID-19 pandemic. As of June 2021, Disney Plus had a total of 104 million subscribers, up from 86.8 million in December 2020 and 60.5 million in early August 2020. The travel-related business of the corporation is projected to recover. Although it's never a good idea to follow analyst recommendations uncritically, it might be useful to utilize their advice as a source of confirmation for your own. Analysts appear to like the Walt Disney Company stock. It currently has 21 analysts covering it, 18 of whom rated as a buy and 3 of whom rated as a hold, with an average price objective of $209.89 per share, implying about 20% increase over the next year. Overall, Disney has had its ups and downs, but you can never count the stock out. The company has a history of pivoting and implementing adjustments that are best for its growth and investors, as was the case with the COVID-19 epidemic. That isn't going to change anytime soon. The Walt Disney Company has a lot of room to grow in the future.
President and the First Lady, they're stepping outside the White House. Let's just listen for a moment.
Number 4. Gevo. Gevo isn't exactly the type of company you'd expect to find on such a list. Gevo is a clean energy startup specializing in the development of renewable fuels. The company isn't profitable and the stock is still selling at a fraction of its value in late 2020. Nonetheless, Gevo has experienced a meteoric increase in 2021. The stock of Gevo has increased by more than 100% year to date, and there are various reasons for this. Many predict big clean energy legislation in the coming months, with President Joe Biden in the White House and Democrats in control of Congress. As a result, enterprises in the renewable energy sector are anticipated to reap the following benefits. Clean energy companies like Gevo will most likely receive grants to fund research and expand the supply of clean energy products. The federal government is likely to continue to encourage clean energy companies by enacting tax laws that favor green energy producers, allowing them to keep more money in-house and offer more competitive clean energy prices to customers. Gevo is currently constructing its first net-zero manufacturing facility. The corporation has a robust balance sheet and a large following among retail investors. Investors can take advantage of Gevo's recent price drop as an attractive bargain opportunity.
On Tuesday night, so that is some dedication. As for the devices, Carl, going on sale today.
Number 3. Apple. Apple is one of the world's most powerful corporations. In the fiscal second quarter of 2021, the IT giant's revenue increased across the board. With a market capitalization of more than $2.12 trillion, Apple is a household name among investors and customers alike. iPhone sales totaled $47.94 billion, exceeding analyst projections of $41.43 billion and representing a 65.5% year-over-year increase. This is an intriguing metric because the iPhone accounts for the majority of the company's income. iPad sales totaled $7.8 billion. This amount, significantly above analyst projections of $5.58 billion, indicated a 78.9% year-over-year increase. In the second quarter of 2021, Apple's wearables and home accessories division generated revenue of $7.83 billion, exceeding forecasts and producing extraordinary year-over-year growth of 24%. The company's high-margin services division brought in $16.90 billion in revenue, increasing 26.7% year-over-year. This expansion is tremendous regardless of where it comes from. These excellent results are the foundation for the stock's extremely strong analyst sentiment. According to TipRanks, 19 analysts covering AAPL stock recommended it as a buy, 5 rated as a hold, and 2 rated as a sell, with an average price target of $157.58 per share, implying a potential gain of more than 24%. After reporting significant revenue and earnings growth, the tech giant stock is now trading at an all-time high. Apple, Amazon, and Netflix are among the tech stocks on the list.
By June 7th, or lose their job. Are you willing to lose your job as a result of not getting it?
Number 2, Upwork. In the gig economy, Upwork is a tech business that connects contractors with people looking for contract labor. The company was formed by an ex-Google employee who was instrumental in development of Upwork.com. For employers, there have been significant changes. Employers now have access to talent all across the world, not just in their immediate vicinity. Furthermore, according to Business News Daily, firms are discovering that employees not only want to work remotely, but that they are also more productive when they do so. According to CNN, COVID-19 caused several organizations to understand this, and many of them have stated that they will never bring staff back into the office. The expanding work-from-home trend and Upwork's ability to capitalize on it, as evidenced by its considerable sales and earnings growth, have analysts praising this company. 2 analysts cover the stock, both of whom rate it as a buy, according to TipRanks. Both price targets are set at $65, implying a potential gain of more than 30% relative to present prices. Granted, you shouldn't trust Wall Street experts blindly, but their evaluations are promising. The bottom line is straightforward. Upwork has already experienced great growth, and with a thriving gig economy and the trend toward remote employment, that growth is expected to continue. As a result, the stock is one to keep an eye on.
Creative sourcing right now, whether that's working direct with suppliers, around the world to find.
Number 1, Amazon. The coronavirus pandemic is a nightmare scenario. More than 174 million people have become ill around the world, with more than 3.75 million people dying as a result. There is no way to minimize the severity of this condition. Even the heaviest cloud, however, has a silver lining. The crisis has benefited e-commerce enterprises in particular. Consumers were told for months to stay at home and only leave their homes in quest of necessary requirements. Amazon.com has announced plans to expand its online store The move comes after travel restrictions and temporary lockdowns led to a flood of people switching from brick and mortar to online shopping. Amazon.com is one of the world's most popular e-commerce companies. Even after a recent dip in tech equities, the company's stock price has risen from roughly $2,545 per share to more than $3,200 per share since June 2020. With this kind of growth, the e-commerce pioneer has not only become one of the world's largest firms, but also one of the market's strongest growth stocks. The stock of Amazon.com has a price-to-earnings ratio of roughly 74, which is higher than e-commerce average of around 55. According to TipRanks, all 31 analysts covering the stock rate it as a buy, with an average price objective of $4,295 per share. This was all about the top 6 stocks to buy in June of 2021. Which ones are you interested in? Let us know in the comment box below. If you enjoyed this video, then don't forget to subscribe to our channel. Give this video a thumbs up and hit the bell icon.